everyone, and welcome back to Stock Market After Hours. My name is Mark Rusin. I'm a CPA here in the state of California, and it is good to be back with you guys as we've had a few weeks off, had a couple of, actually 3 different workshops that we did in the past 4 weeks or so. So our live shows have been a little bit more scattered there, but I also have a poll running on YouTube. So definitely check that out because we're looking to see, what type of content you guys enjoy and like, and whether these live shows are helpful or if you would like a more scripted stock market update video that comes out on Wednesdays, and then we kind of squeeze in a live show on a different day a couple times a month if that's something that interests you. So definitely check out the post, the community page that I put out on my YouTube channel, and make sure you put your vote in because I want to hear from you guys. I put out this content for you guys on a weekly basis. 2 regular videos and the live show is kind of how we have things set up right now. But again, I want to see what's most useful to all of you as well. So again, it's another ending with the markets at record highs. It seems like this is just a regular thing in the market now. And if you're new to investing, it seems like stocks only go up. And I want to caution you that that's not the case. Over the long term, yes, you actually can't go and find a 20 consecutive year period in which the S&P 500 is negative after those 20 consecutive years. You can mix and match any 20 consecutive year period you want. You won't find one. So over a long period of time, yes. And that's why you want to be invested. And I say it often in plenty of my recent videos that we don't really want to focus as much on trying to time the market as we want to have time in the market. Now, that doesn't mean we don't make tweaks. We don't take profits. We don't take losses and things like that, because tax loss harvesting goes into making money, managing our portfolio, not being overexposed, not having too much risk in our portfolio is part of the cycle. So no, we don't just invest and come back 5 years later. We invest, and whether you want to be hands-on or hands-off, we make tweaks. So, and I make plenty of tweaks, and you can follow all of those as part of an Edge Plus subscriber with our newsletter. So, well, let me know where you guys are tuning in from. What have you been buying, or what have you been selling in your portfolio of late? I see John Bircher. Good to see you, my friend. We have Matthews in the house. Mark Payson, happy wonderful Wednesday from rainy Lehigh Valley, Pennsylvania. No rain here in Southern California. It's a warm 82 degrees in Orange County. We got the traveling trader from Indy. Took some TSM long this week. Nice. Hello, Mark from another Pennsylvania. Nice. SCHG for Hoagie. Good to see you, my friend. Jeffrey, Southwest Washington, bought some CRM on the dip. Software stocks have been really in the red a lot lately. Been doing some option plays there. Good to hear that. Asmara Fishing from Geneva, buying OWL, not a BDC, and undervalued water utility stocks. There we go. There's some interesting plays there. John Benoit from Connecticut, Massachusetts, buying ASML, ISRG, Novo Nordisk, and UNH. You're buying the dip there. There's some dip buying that's been going on. Juan, will there be a pullback showing today's red doji candle on SPY? I'm looking for a pullback. Can never tell you the exact day, but over the course of the next 4 weeks or so, I am expecting a decent little dip here. Jedi, good to see you. Cindy, good to see you. Jeff from Colonial Williamsburg. Williamsburg, is that where the Little League World Series is played? Someone can correct me if I'm wrong. I might be wrong. Jim, tuning in from Maryland. George, buying some Palo Alto on the dip. I like that. So we've had software stocks that have really been dipping, and cybersecurity in particular have been dipping there. Slowly moving back into cash. Closed out of Lulu, Baba, and VKTX long calls for a nice green. John Gallegos in sunny Arizona. What part of Arizona are you in there, John? Eric, Utah, DGRO, and Mara. 2 very different plays right there. Awesome. Well, let's jump into what we got going over the markets today. Let's start by jumping over to the iPad and take a look at how the markets are performing so far. So let's begin with our Dow Jones. So as you can see on your screen here, the Dow Jones is up 5.6% so far. John's over in Chandler, Arizona. All right, Costa Rica in the house. There we go, Alejandro. Buying MU and S over the past 2 weeks. Love it. All right, so we got the Dow Jones up year to date 5.6%, up 12.3% over the past year, and just 1.5% over the past month there. If we head over to the S&P 500, we could see on a year to date basis up about 10%. And when we compare that, I always like to compare it to the RSP, which is the equal weight S&P 500. That's up a little over 7%. So not too much of a gap right now. That tells us that, you know, the rally that we have seen so far this year has at least been broad, and we will look at the sectors, which will confirm that it has been broad and hasn't really just been 2 or 3 sectors that have been carrying the weight like we saw in 23 and 24. So up 10%, 18.5%, never going to complain about those gains, and up 3.2% over the past month, a lot of that just coming in the past 5 days alone. If we head over to the NASDAQ, tech-heavy NASDAQ, up 26% over the past 12 months. Year-to-date basis, up 12.4%. 3 months, 13 over the past month, a little shy of 5%, with half of that coming in the past 5 days alone. We've kind of hit another gear here in the past few days, or the past 5 trading days, I should say. Take a look here at gold, though. Gold's been the big winner. Whether you want to find tech-heavy NASDAQ, S&P 500, Dow Jones, had you just invested in gold, you'd actually be outperforming. So gold up 37% over the past 12 months, 29% on the year. So much of that coming here in 2025. However, over the past 5 days, down almost 1%, and pretty muted over the past month here. So that's definitely something to watch when we are talking about a dip to potentially coming. I put out a recent video just kind of giving you guys my perspective. It doesn't mean that, hey, tomorrow we're going to get a dip, because people come out and you can kind of scroll through all of the comments saying, well, Mark, we're up again. I'm not trying to put the exact date on a dip. I'm trying to help prepare you ahead of time for what is potentially a choppy period in the markets. And we'll talk more about that here today. So let's take a look here at the 10-year. So there's a few things that I want to focus on as an investor when managing my own portfolio. That's going to be looking at treasuries, because again, the bond market is much, much larger than the equities market. We want to look at gold, because typically a lot of investors will move over to cash and put some money into gold when they're concerned about what is on the horizon. Well, what we've seen from gold has been very productive there. But looking here on your screen, you can see the 10-year treasury currently sitting at around we'll call it 4.25 if we want to round up right there. So that's the year-to-date chart that you could see. If we take a look at the 2-year notes, currently sitting at 3.68, we will call it there. So, you know, those are down 56 basis points on a year-to-date basis, and over the past 3 months down 37 basis points there. So something to watch. Treasuries and gold there. So let's take a look at those sectors, though, because remember I told you that I like to always compare the RSP to the equal weight S&P 500 to the actual market cap weighted S&P 500. Because if you go back to 23, 24, huge runs in the S&P 500. The Mag 7 really accounted for over 50% of all of the gains in the S&P 500. We saw communication services, we saw infotech at the top, and consumer discretionary there. Those 3 made up the large majority of all of the returns there. You saw a number of sectors that didn't perform all that well and were well under the actual performance of the index in and of itself. However, when we look here today, we could see that if we move over to a year-to-date basis, the S&P 500 is up just shy of 10% here, but you can see a number of different sectors that are outperforming the S&P 500. So if we go over to the iPad right now, so here's our S&P 500 right there, call it 9.6%. Well, you got communication services is outperforming that. We have industrials, which has been one of the better ones, outperforming. We have technology outperforming. You have utilities outperforming. So a number of different sectors there that are outperforming the S&P 500. What has the laggards been? Healthcare and energy. And you could lump real estate in, which kind of just turned there. But when it comes to long-term investing, though, I don't want to just chase the high flyers. I'm not going to run and buy a Palantir at a 200x multiple there, because any valuation metric, and again, these high flying growth stocks, you can't really use traditional valuation metrics to assess them. But high flying like that, I prefer to look at what are some of these underperforming sectors, because if we do in fact fall into a slow period, it may not necessarily be a slow period for across the board. It may just be investors and money managers saying, hey, I'm going to take some profits here. I believe in NVIDIA long term. I believe in Palantir long term, CrowdStrike, a lot of software names, so on and so forth. But I got to take profits at some point. That's the thing with growth stocks, is you do have to, in fact, sell to cash in on those profits. Dividend stocks, you're going to get paid on a monthly or quarterly basis. So at least you're earning some return. And again, I'm not saying one is better than the other, but with growth stocks, you are forced to eventually sell. Remember, NVIDIA, CrowdStrike, Tesla, all those big names, they were down more than 75% in 2022 at one point in time during that specific year. Imagine being up so much in those stocks and then holding on, saying, okay, it dipped, it's going to bounce back, and then whoosh, 75% of your gains are gone. We have to sell stocks in order to cash in on some of those gains, especially if you're in a taxable account. We need to think about the taxable implications. And that's what leads us into the downturn and the slowdown that we typically see in September. We are roughly 9 months through the entire year. Okay, so 75% of the year is completely done by the end of September. And when you look at that, money managers, investors have to start thinking about taxes. We have to show gains. Money managers. I'm not a money manager, so I'm not forced to sell like some of these professionals are, but they have to sell. And they don't want to leave, they want to show gains, but they also don't want to leave a massive tax bill. So they're going to look at some of their lower performing stocks that maybe they're not all that crazy about. And they say, hey, we can sit here and hold on to this stock and see if it gets back and climbs back to towards even, or how about I sell it right now? And those losses can help offset some of the gains, which lowers my tax bill. It's a win-win for them because they're lowering their tax bill and they're reducing a position that they may not be all that crazy about moving forward anymore. But both sides of that transaction, which I talked about in my most recent video, is selling. You have to sell the loser and sell the winner and take profits. That puts overall pressure on the market. That's what we see a lot of the time in September. It's also the first full month back when kids are going back to school, vacations are winding down to a degree. I'm still trying to go on some vacations. So we got plans to go out to Central California a little bit. We're going to go, try and hit up Hawaii before the year's over. So we'll see what happens. I don't let school try and stop us at all there. All righty. Let's keep going here. What else do we got here? All right. So will the bull market keep going? So here I wanted to take and show you guys, we've shown these in other videos here before, is the fact that, talking about that September being a downturn. Again, notice that we're just in mid-August here. I'm trying to prepare you. This doesn't mean we have to go and sell out of a bunch of our positions tomorrow. It's prepared. Take a fresh look at your portfolio. Where are you overexposed? Look at your sector allocation. Look at your individual stock allocation, because stocks have grown so much. There's plenty of stocks. You look at an Uber that's up, well over 50% on the year. Some of these positions could have outgrown their rules within your portfolio. I have rules for my portfolio from an individual stock performance, from a sector performance, and things like that. So that's where we want to take a fresh look. But you can see pretty clearly there that September is, in fact, the biggest negative on this chart here. And I explained that just a second ago there. So here is dating all the way, back to 1950 by day. So you're looking at your months across the top there, January through December. And then you could see by day. This is some data. When I came across this, I was like, holy smokes, they broke it down by day. And we could see that 2-week period, the last 2 weeks of September, that's really when a lot of this selling pressure happens. You could see that, of that, only 2 days are actually positive, the 27th and 28th. Again, these are averages dating back. That doesn't mean, let's target September 20th. Let's do it ahead of time. That's why I put the video out, is to prepare you to start game planning, not to do it right away, but to start game planning to see how and feel how, the rest of August. August is usually an okay month, so we don't have to rush and sell right away and things like that. But I'm constantly looking to analyze my my portfolio to see where do I need to take gains, where do I need to lower some exposure, so on and so forth from that standpoint there. Jedi's got a question here. How much should we be in cash? How much should we be in cash? 50%? I don't know. I think 50% is way too high. So for me, again, timing the market is very difficult to do, and it's constantly a losing strategy here. So for me, on let's just say, we're in a regular market, things, there's not a ton of uncertainty out there like there is right now. I usually always like to keep around 5 to 8%, call it, in cash. Reason being is we never know when opportunities are going to persist, and that's why I always talk about with you guys is it's so important to maintain a watch list, because when those stocks drop, you have a momentary chance to jump into these before we could potentially see a bounce. You don't want to rush in and catch a falling knife. So just because a stock is falling doesn't mean we just go in and buy it. But if things are overblown, like I think of a company like PayPal. PayPal issued earnings, which they were actually pretty decent. We had a beat on the top and bottom. Guidance was okay. We're starting to see, volume do well, and the internal metrics that I like to focus on. I was fine with PayPal. Guidance was okay. It wasn't great, but that was clearly the downturn there. I thought it was a complete overreaction from that standpoint. Now, if you look at a company like the Trade Desk kind of flopped, and it's kind of the same game plan that we have seen from a few months ago when the stock got hit rather hard here. So that is one that clearly the competitors are taking a little bit more than management was leading us to believe initially there. So that one, I want to take a wait and see approach when it comes to the Trade Desk. May still look for some option plays. Anytime we get a drop of 30+%, that's a time to jump in and say, hey, can you drop another 10 to 20%? If not, I'm going to collect some income from the option side of things. And speaking of that, let's jump over and take a peek real quick at our options for any of you guys that are interested, since we have a flash sale going on. It's going to expire today at midnight, so do be mindful of that. But we are going to jump over to this really quick. So let me show you guys. This is our weekly. So anytime you are part of our options Edge Plus, you're going to get our weekly update. It's going to go through all the stocks, all the positions that we opened, any of the positions that we closed. Again, you get to see these in real time within our Discord community, but I like to kind of put them in a nice document for you guys to kind of read and talk about, especially the ones that I have open. What are we looking for? Are we looking to take profits, cut losses, things like that from that perspective? But last week alone, again, if you had just followed the trades and you just did one option contract, again, I do multiple contracts, but I like to show everything as if it was just one contract, because I'm going to let you choose how many contracts you want. I'm going to lay out, okay, here's your potential gain, here's your potential loss, cash outflow, things like that. Folks that have a much larger account, they can afford to do multiple contracts. Those with smaller accounts can still participate, but maybe they're only following with one contract. But had you followed with one contract, we had a total of 11 new trades last week, 6 open from prior weeks there, and we closed and profited from 3. From those 3 contracts alone that we closed, those 3 positions, $783 in a week. That is fantastic right there. This is a subscription, guys, that costs you $60 a month, and we just kicked out $783 in gains. We're an open book. We're not trying to hide things here. We're not saying we're turning $5 into $5 million. I'm showing you how I utilize options to get into positions a lot of the time, but also for income. $783 right there. That would have taken care of more than a month or more than a full year of Options Edge Plus, and you had some left over from that standpoint right there. So fantastic week over there at Options Edge Plus. And right now we do have a sale going on, which you can find that link down in the description. You get 10% off to give us a try. You can do the monthly subscription. You can do the yearly subscription. It's only a one-time use. So you choose. If you do the monthly and you love it, which we have very little turnover here, guys, and you love it, don't come back asking me for a 10% discount on the annual at that point. It's a one-time use. So you can check out that link down in the description below. Another update to pass on to you guys is my Stock Market Kids Investing Workshop. So that's going to be coming tomorrow. So this is going to be going through a bunch of exciting topics for me on how do we get started investing for our kids, grandkids. It could be for even from that nieces and nephews and stuff. We're going to go through all the different accounts, which ones are more beneficial, can't even speak, less beneficial from that standpoint. If you own your own business, how can you have your kids on payroll and pay them that way to start like a Roth IRA? We're going to be touching a number of different topics in this workshop. Again, this is just one of our lower cost, doesn't cost a ton to join this particular workshop here. We keep the groups very small, just to be able to answer as many questions as we can. It's not open to as many folks as we have for our options and our valuation ones. So if this is something that interests you, tomorrow at 8 p.m. Eastern Time, 5 p.m. Pacific, we will be doing our Stock Market Kids Workshop. If you can't join us during the live portion, you can still sign up and receive the recording from that standpoint there. So again, there's a link down in the description below for you to be able to check that one out. Would love to have you guys there. All right, so let's get back to the iPad and going through the market updates. So since we've last met together, we had our CPI report come out. We've had jobs report come out, CPI report. So let's take a peek at the CPI. So CPI came in this week actually at 2.7% annually. That was for the month of July. That was less than anticipated, less than expected. So again, this was a big report for me personally, because June and July were those ones that I've talked about openly on this live show on saying, when are tariffs going to start making their impact? Are they going to make an impact? Are they going to have a big impact? Or is this something that maybe it's not going to be as much and maybe companies are eating it? One way or the other, companies are going to eat it, which is going to reduce their margins, reduce their earnings, or they're going to pass it on to consumers by raising prices, which will be reflected in CPI. On a 12-month basis, came in at 2.7. That's just for your regular CPI reading. Solid right there. When we're under 3, very solid. Investors were happy. We saw markets increase yesterday. Now, obviously, we always want to not just look at the headline numbers. We want to dive into these things a little bit more in detail. So with that, as you know, I like to look at what's called Core CPI. And what Core CPI does is it excludes volatile readings from both food and energy. That increased 0.3%, and it was actually up to 3.1% on an annual basis there. So let's take a look at the chart down below. You can kind of see where things are at right now. 2.7%, 3.1% on the Core CPI. Now, CMG Venture, one of my partners over at the Stock Investors Edge newsletter, he does a fantastic job with all of the back end and all of the reports and research data, everything behind the scenes. Chris is one of the best in the business here. He found this one actually on the Bloomberg terminal, which actually looks at not CPI, not Core CPI, but Super Core CPI, which is taking an even deeper dive into the actual numbers, looking at things like services, which is more sticky. When we see prices having to go up there, it's a lot less likely that we're going to see a quick fall down and it's a one-time use. So Super Core actually increased by 0.48. We saw very minimal 0.2, 0.3 on a month-over-month basis from regular CPI and Core CPI, but it was actually much more focused on Super Core here, which is actually almost up 50 basis points right there. And that was a little bit more concerning. Once he sent that, I messaged him in the morning, say, hey, wow, the CPI rating was actually much better than anticipated. Maybe we're kind of getting in the clear. And he goes, hey, hold the phone there real quick, Mark. And that's why it's always great to bounce ideas off one another. And that's why I've built my Stock Investors Edge community, is because it's not me looking to profit, Chris looking to profit. We're looking to profit as a community. We are looking to help build generational wealth for our community as a whole, as we can all ride to the top of the hill together from that standpoint there. So something to be mindful of with, okay, maybe this pricing thing is starting to kick in from tariffs. Another side to look at market, we've got unemployment rates coming out. So the one that I'm looking at that I don't pay much attention to the week by week jobless claims, because there could be things that go on from a week to week basis. However, for me specifically, I like to focus on that continuing, the rolling 4-week period there. People getting laid off, do they find jobs quickly? If they're finding jobs quickly, they're not going to show up in the continuing unemployment claims. But when we look at the continued unemployment claims, you can see that this is actually the highest level that we have seen now since 2021. And it has steadily been increasing since the start of 2024. 2025, kind of a little muddled there, but now we have peaked back up nearing 2 million there. So this was as of the end of July, so a few weeks ago from that standpoint there. So definitely something to be mindful of. We have unemployment sitting back above 4 at 4.2%. We saw huge, massive revisions on the latest jobs report as well. So tariffs starting to make on the services side of things an impact on pricing. Folks losing jobs, again, not at record levels, but they're not getting hired back as quickly for those that are losing their job. And another way to confirm that is by looking at job openings or the JOLTS report. And as we could see, when you look at the JOLTS report here, that, well, things are starting to run a little slow. And a lot of the job openings are starting to creep down a little bit further. So companies are starting to get a little bit more stressed out to a degree. And it's always going to be the smaller companies that will get stressed out first. So there is strain on the economy. Anyone that thinks otherwise is just not looking at the data and just reading headline numbers. And we don't want to ever read just headline numbers from that perspective there. So an edge, if the market turns bearish, you give put option recommendations. In the options edge piece, we're constantly doing all sorts of different option trades, cashiered puts, covered calls. If the market is falling, we're going to turn to a lot more covered calls, credit call spreads, and things like that, because that's the great thing about options, Jedi, in reference to your question, is regardless of the market's going up, going down, trading sideways, there's an option strategy to utilize to generate income from. That's the good thing about it from that standpoint. Dennis said, I've decided to be an SCHD millionaire. Love it. Stoic says, we're in a bubble. Should I be a REIT millionaire or an SCHD millionaire? I can't decide. How about both? Can't go wrong with both there. All righty. So JOLTS. And then I wanted to reference to those revisions that we talked about there in the latest jobs report, which wasn't necessarily a great reading here. So if I zoom in here, we can see that the revisions for May and June were larger than normal. And those weren't great, because we could see here, 19,000, that was a big adjustment. There was only 19,000 jobs added. And then 14,000 were added in the month of June. And then in the month of July, it was about 73,000. So we're sitting a little above 30,000 jobs added on a rolling 3-month average period, which isn't all that great, especially compared to the numbers that we were getting. 144,000 jobs were added, 147,000. No. That wasn't the actual case, according to the data. Whether we want to say the data is correct or not, I don't know. I think we could probably, this day and age, there's a lot of technology that we could probably lean on to do to take these polls a little better, but that's just me from that standpoint there. So the data is what it is, and we do have to be mindful of is this economy doing as good as some think that it is doing right there. So, alrighty. So let's jump back here and let's go over to the Fed watch. So what does this all mean for the Fed? We talk about the Fed on a regular basis on our live show, and we know that the fact that we just saw super core and core is back above 3. Super core with services, sticky inflation, not as easy to change pricing on and things like that. The jobs market, continuing unemployment, it's at the highest we have seen since late 2021, continuing to climb higher. We're looking at the JOLTS report that's showing that there's not as many job openings as there once was. So if you do get laid off, you're not finding a job quickly, and there's not as many options out there for you. The Fed has a dual mandate, monetary policy and the labor force. Again, they have continued to be late to the game. They were way late in raising interest rates, which we saw inflation just get completely out of hand. And now we're looking that if they do not, I've been, you can go back to all of my live shows posted on YouTube this particular year, and you've probably heard me talking about a rate cut in September. So here we come, September, about a month from now, a month and 4 days from this video recording is when we will have our next Fed meeting. And if they, in fact, do not cut rates that particular day, I would be shocked. So there's reasons to be optimistic as an investor if they do, in fact, cut rates, but there's also reasons to be pessimistic if they cut rates. Pessimistic is the fact that we're looking at right now. Usually rates come down when the economy is showing sluggish signs, job market showing sluggish signs, tariffs starting to make a little bit of a impact on pricing and earnings and growth and economic activity from that standpoint there. So that's pessimistic. Optimistic is, okay, well, that could be a tailwind towards the back end as long as the economy can stick together, as long as the consumer can stick together. So when we look at the CME Fed tool right here, we could see that there's a 95% chance that rates are going to be cut by 25 basis points. There's a 5% chance that they're going to be cut by more than that, by 50 basis points. And when we go out to the probabilities, right now the markets are looking at, as of 2025, you could potentially get 3 rate cuts between the September meeting and the December meeting. So there's only 3 meetings left, September, October, December. And right now, as of December 10th, there's a 54% chance that rates will come down by 75 basis points there. So something to be mindful of, but I'm definitely still in the camp that we're going to get a September rate cut. What happens after that could be anyone's guess there. So looking at the economy from a different angle, we can look at GDP. We're not going to get the next GDP reading until the end of this month, so we're still a few weeks away from that. But at the same time, real GDP is coming in under what we did last year. As you could see, Q1, we were negative. Q2 is expected to be around 3% there. But if you look back to 2024 on the side there, you can see that we were at 1.5% in Q1 and 3% in Q2. So the run rate there for the first 2 quarters of last year, much better than what we've seen this year from that standpoint there. Depends on the stock, James. So the stocks normally drop after Fed rate cuts there. So it's going to be a pressure release valve for companies like REITs. Doesn't mean REITs, right when the announcement comes, are going to jump from that perspective, but there are many interest rate sensitive sectors that are out there, and REITs, real estate investment trusts, are one of them. So that is something that I'm going to be excited about, is looking at the REIT market there. But again, REITs do well when the economy is doing well. So if rates come down and the economy falls apart and we're heading towards a recession, which that's not the camp that I'm in right now, well then no, just because rates are coming down, REITs are going to they're not going to do well. So we need things to kind of go in our favor from that standpoint there. So looking at this FactSet report, this came out last week here, we could see that the earnings scorecard. So let me get the iPad going here real quick for you guys. We have 90% of S&P 500 companies that have reported. 81% have reported with positive EPS and 81% with positive revenues as well. So it was a good quarter, but at the same time, I would say that it's probably, not earth-shattering to say the fact that earnings estimates did in fact come down heading into the quarter right there. For Q2, S&P 500, 11.8% on the earnings rate growth. Pretty solid there whatsoever. Valuation-wise, we have a forward PE multiple sitting at 22.1. The 10-year average is closer to 8.5 there. So something to keep in mind. Valuations looking a little bit stretched. But we'll have to see how we still have a long ways to go in terms of Q3 earnings and Q4. But I am optimistic for a solid back half of the year. I think we're going to get a better opportunity if you told me right now, hey, Mark, a month and a half from now, over the course of the next 4 to 6 months, do you believe the stock market will be higher or lower? And again, my magic 8 ball stopped working eons ago. So don't sit here and quote me on it saying, hey, Mark, you told me. It's anyone's guess from that perspective. But looking at the stats, looking at the facts, the economy, the job market, looking at earnings and things like that, I would say we're going to get a chance to get a better entry point opportunity. Now, does that mean we go out and sell everything? No, not necessarily. But if you do have big winners that have kind of overextended their stay, or they've outgrown their position sizing that you like in your portfolio, then sure, take a little off the top and rebalance your portfolio. That's why September is historically the worst performing month, in my opinion. Many money managers are rebalancing their portfolio. They're doing tax loss harvesting, and both ends, whether it's a winner or a loser, involves selling. More selling than buying, markets come down. That's just the way the cookie crumbles from that standpoint there. So over the course of the next 4 to 6 weeks, I believe we will get a better entry point. I still believe we will end the year, though, at a higher point than we are today. So still optimistic, but a little bit more pessimistic in the near term, if that makes sense from that standpoint there. So before we head out here, let me jump over to our charts really quick. So let me go back. Let's take a look at where we're at on the S&P 500 as a whole. So taking a peek here at TradingView. No, I don't want any of the ads. Here's a look at where we're at. So as you can see right now, we have the RSI that's sitting a bit higher than we like to see, hovering around 70. Obviously, we're at a fresh record high yet again for the S&P 500. It seems like a daily basis. We saw a little bit of a dip there. So, but what I want to do here is I want us to go out on our weekly basis chart here. So let's go out on our weekly basis chart and try to ignore all the green lines that I have for myself there. But if we put together a trend line from this low point here back in 2023, we can kind of potentially see that where the S&P 500 has been cratering and kind of finding support on from that standpoint. So that would put us right around this is looking at the SPY, so around a 510 level. Right now we're sitting at 645. So we had support here. That was the bottom. We had support here in fall of 23. And then in going into April, the big drop, we found support there yet again. So this is a sizable drop. If that would be kind of the worst case scenario. And I don't believe that we're going to fall that far because we have some other barriers here. We have the 50-day moving average, which is this yellow line. So that puts us right back around 600, which I think is the near-term area to test. That's less than 10%. That would even equate to a correction. You have the 100-day moving average, which is this red line right here, puts us closer to around 560. I think that is the more realistic baseline if we do, in fact, get a sizable pullback. That, again, this would be healthy for the markets here. And looking at that high RSI, you can see coincides with some pullback. So anytime we get above 70, you can see markets have pulled back almost every single time. So RSI right now isn't quite at 70, but if it does, in fact, creep a little bit higher there, that's the point in time that I would be a little bit more mindful of looking to buy and rather be actually looking to sell there. So, but there are some stocks out there that are starting to look a little bit more juicy, and we're already starting to see a pullback on. We talked about early on with software stocks. You could see a lot of cybersecurity names have been pulling back. CrowdStrike has gone from 520 down to 430 right now is where it's at. So looking at retracement levels, we're at around that 38% level. And I'd really be focusing on that 405 level for CrowdStrike there as a spot to maybe nibble if you don't have exposure to it yet, and keep an eye on that whatsoever. If we look at the VIX, we can see it's at a very low rate of just 14 right now. So if we do in fact get a spike up in that, that's when a lot of this stuff is going to start taking place there. In terms of the volatility, in terms of actually getting meaningful pullback here, I'm not talking about a 1% pullback or anything like that, but just a couple, high level charts that I wanted to focus on with you guys whatsoever. But that's kind of an overview on where we're at on the market today, where we think we could be heading in the market. But with that being said, I do want to bring your guys' attention again to, if you haven't yet signed up or if you're just joining, we do have our Stock Market Kids. If you have kids, if you're planning to have kids, if you have grandkids, nieces and nephews, this is just going to be a great resource for you to keep for as long as you want to check it out. That it doesn't expire from that standpoint. So we will be going live. If you are able to join the live, that will be tomorrow for this workshop, going through the best accounts to set up for your kids, whether you own your own business or you are employed or whatnot. All the different types of accounts that you can look at for kids, how to get kids interested. I have a couple of kids myself, and they'll go down watching dad have CNBC on and go, "Oh, Mark, my stock doing good." Or they don't call me Mark, they call me dad. But stocks are green, stocks are red, daddy, things like that. So are we winning money, making money, losing money? What are we doing? So they are interested in that, and I'll talk about how I got them interested in stocks and things like that. So it's always a fun one because it's near and dear to my heart. And it's just a way to set up your kids, grandkids, nieces and nephews and things like that just for success. This isn't necessarily something that I had as a kid. I didn't start investing until mid to late 20s in a big way. I started early in my 20s, but it wasn't meaningful dollars like it was in my mid to late 20s and into my 30s from that standpoint. So anything that you can get started, it's not big dollars to get them started. Small amounts at such a young age makes huge impacts over a 20, 30-year period from that standpoint, and you can set them off into new heights there. So Gary said, "My kids love the market." Awesome. Love to hear it there. Hope to see you there tomorrow, Gary. Jeffrey said, "My kids don't know they like it, but they eventually will." They sure will, Jeffrey. So awesome. Well, and again, just to remind you guys one more time, we have our Options Edge Plus flash sale going on that expires tonight. You can get yourself 10% off either a monthly or annual one-time use subscription to Options Edge Plus. So definitely check out the link down in the description below. And with that being said, it is great to be back with you guys. Thank you all for joining me today. Make sure you take that poll on our on the YouTube website there, just to understand, or on my channel site. Do you want more scripted videos with stock market updates and things like that, and maybe less live shows, or do you like the format of having these weekly live shows? Let me know, because I want to do what you guys like most and enjoy in terms of a content perspective. So thank you guys again for tuning in today. Went a little over our 30-minute normal rate there, but wanted to make sure that we jumped in since we hadn't been doing this for the past week here because of the workshops we had going on. So it's great to be back with you guys, and thank you guys so much, and we'll see you next week. Take care.